Today, I'm putting 6 popular ETFs against each other in a unique way by only judging them by their top holding. I'll be ranking these ETFs from worst to best in no particular order. Now, why am I only judging these ETFs by their top holding? Well, think of your own portfolio. What does it mean when you look at your top holding? It means that's the stock you are most bullish on. It's one of the main drivers of growth or loss for your portfolio, but hopefully growth if you choose a high quality top holding. So I feel the same way about ETFs and want to see what they are putting the majority of their weight behind. I'm going to do a quick financial analysis on each ETF's top holding, its allocation in the ETF, and then a quick personal insight on my thoughts before I decide where to rank them on this rankings chart. This is also a good way to look at your own portfolio because I know some of you may question, why the heck is this my top holding? It may help you make some necessary changes to your portfolio, and yes, we will also look at my portfolio and my top holding, and I will give you my honest opinion on it. Okay, the ETFs I selected are ones I feel are very popular, and they are SCHD, SPHD, SPY, MOAT, ARKK, and VWO. So we will start with the ever so popular dividend growth ETF SCHD. Now we're going to look at the 1-year performance for all the ETFs and all the top holdings, and with SCHD it's up 8.19% over the past year. That's about average returns for the stock market, so this is not bad. If we look at its top holdings, we'll see Verizon makes up the top spot at a 4.11% allocation. Anything over 5% I deem a significant holding, so I don't deem this a significant holding. I think it's pretty responsible. Now Verizon over the past year is up 5%. Now there's a lot of bonds and high yield savings accounts that you can get even more return than this. So I would say this is trailing what I would deem that average of the stock market, so not great performance. And if we look at Verizon's stock facts, we will see its PE over the trailing 12 months is higher than its 5-year average. So investors are building in some higher expectations here. So it's at the 15.29% PE ratio now versus the 5-year average of 11.28. Price per operating cash flows is pretty inexpensive. It's pretty cheap at 6.11%. Cash flow growth over the last 5 years is negative 2.35%. Revenue over the trailing 12 months is negative 2.09%. And revenue growth over the last 5 years is a measly 0.47%. Not great numbers with cash flow and revenue growth. The gross margins, however, are pretty solid at a 59.09%. Return on equity is okay at a 12.28%. I like to see this above 20%. And then the debt profile ain't that great. The debt to assets are 46.17. For me, anything above 50% here, I won't even look at, so this is just below that, but that debt to equity is extremely high at 185.86. Now the dividend yield is 6.27%, that is pretty high, but that payout ratio is a 96.73%. That to me is putting this dividend at a risk of being cut. Now the last 1-year growth and 5-year growth both come in just shy of 2%, so it's really not growing above inflation. It's not beating, that's coming in below. So really, so far, I'm not that impressed. There's some weakness here. Now, with SCHD, they have a very low expense ratio of 0.06. That is fantastic. And they pay a dividend around 3.5%, which is not bad because this investment also appreciates over time with that 3.5% yield. So that's pretty good. So unfortunately for this first one, I am going to rank it in 6th place because Verizon is one I would never invest in. I do see that this stock has, as well as AT&T, they've been beat up for a long time now. So maybe there's that chance for a turnaround. It does provide a necessary service, but right now SCHD falls in 6th place. Next up is SPHD, and this is a high dividend, low volatility ETF. It has not done that great over the past year. It's only up 3.91%, so that's more than half of what SCHD performed. Its top holdings, you'll see what comes in at number 1 is Altria. This is a tobacco company. It does make up a lower percentage of the total fund at 2.98%, but I will tell you, I held this stock for a little while because I chased that yield. It was an awful performer for me. I do not like this company. I especially don't like it as an investment. Now, Altria over the last year is actually down 6.28%. So negative performance, it's losing you money. If we look at its stock facts, you will see its price per earnings trailing 12 months is 9.12 versus the 5-year average of 26.08. So investors are losing confidence in this company. Its price per operating cash flows is low at 8.77. Its cash flow growth over the last 5 years is only 3.16%. It has slightly negative revenue growth, and over the last 5 years, its revenue has only grown 0.88% on average. So really, the revenue is a sad story. That cash flow growth is very minimal, but the gross margins are high at a 70.37. But you got to think, people get hooked on these products, so this company can charge those high margins, make that high profit, so that makes sense. But that return on equity is negative 221.98, and I just want to jump down to the total debt to equity at the negative 709. So what is making these large negative equity numbers? Well, the company has negative shareholder equity, which has been the result of large dividend payments, lower retained earnings, and excessive debt. So negative shareholders' earnings means the company's liabilities exceeds its assets. I'd rather have a company with high debt than negative shareholders' equity. So this is not good to see. Now, its total debt to assets is really high at a 69.73. Again, anything above 50%, I wouldn't even look at. Now, its dividend yield is extremely high at a 9.44%. Its payout ratio is very high as well at 85.78. I also think this company may be at risk of a cut someday. And the growth for the 1 year and 5 year are both above slightly 4%, which isn't horrible, but it's not great, as you will see some other examples that we will be covering. So SPHD, it has an expense ratio of 0.3%. So that is actually pretty high. Again, SCHD was 0.06%. Now the yield on this fund is higher at a 4.63%, but at what cost? This fund is not really making you money. So with that said, I think Altria, I'm gonna put in 6th place, which bumps SCHD up to 5th. I just see this company as providing a product that people eventually, slowly but surely, will stop using. It's a dying business. So to me, 6th place is where I'm putting this. Next up is SPY. This is an S&P 500 ETF. So basically it kind of mimics the S&P 500. And over its past year performance, it's up 27.16%. That is amazing. That is great returns. And if we look at its top holdings, it's no surprise, Microsoft is in 1st place, and Microsoft has really done well as well, which makes sense, but its weight is much higher than what we've seen at 7.19%. So you could say this is a little risky, but to me, Microsoft in itself is its own ETF with its own diverse businesses, its wide moat, so I do not see this as risky. Now, if we look at Microsoft over its past year performance, it's up almost 50% over 1 year. That is phenomenal. And if we look at Microsoft stock facts, we will see a very solid company. Now, its price per earnings trailing 12 months is 38.48 versus the last 5-year average of 30.49. So I will say this, I do think it is slightly overvalued. I do not think, and I want to repeat, I do not think this company is in a bubble. I think it deserves this PE ratio for the trailing 12 months because I see a long runway of growth. Now its price per operating cash flow, again, is expensive, 31.11%, but that's what you're paying for, those future cash flows, and I believe Microsoft will generate massive free cash flows in the future. Cash flow growth over the last 5 years is an impressive 26.53%. Revenue over the trailing 12 months has grown 11.51%. Over the last 5 years, 13.94. So yes, the revenue, anything in the double digits is where I want to be when I invest in a company, and this is great. Gross margins are beautiful at a 77.35%. Return on equity looks really healthy at a 38.4%. And Microsoft has a low debt profile. Debt to assets come in at 22%, and that debt to equity is 43.7%. Now they do pay a small dividend, it's a 0.72% yield, but they have a low payout ratio at a 27.12%, and they grow this dividend very healthily. Look at that. The 1 and 5 year growth is over 10%. That's great. That's giving you a 10% raise every year. Who gets to say they get a 10% raise every year? So if we look at this fund, it has a 0.0945% expense ratio, which is very low, so that's good, and it pays a dividend, 1.25%. And again, Microsoft is only 0.72, so it's paying you more than Microsoft. So I just have to rate this ETF SPY with its top holding of Microsoft in 1st place. Microsoft to me is just such a solid company, and SPY has been outperforming. I don't see this turning or changing around anytime soon. Now let's look at MOAT. This has become a very popular ETF. They invest in companies that they believe have wide moats. Now over the last year, this ETF has done well. It's up over 21%, so that's very solid growth. If we look at its top holdings, the top company is called Corteva Inc., and it makes up 2.78% of this portfolio. Now, Corteva, I had to look this up, but it's a major American agricultural, chemical, and seed company that was the agricultural unit of DuPont, and then it was spun off. So it's kind of newer to the market. If we look at its past year performance, it hasn't done well. It's kind of with Altria. It's gone down 6.37%, so it's losing investors money. Now, this company was spun off and it went public on May 24th, 2019, so some of the 5-year data might not be available, but if we look at its stock facts, we'll see its price per earnings. It's pretty pricey. They're asking 43.56% over the trailing 12 months, and its past 5 years is a 35.28. So investors have been expecting more and more from this company as of recent. Now, its price per operating cash flow is pricey. It's at 18.80%, but look at that cash flow growth. Negative 2.55% over the last 5 years, and that revenue trailing 12 months is negative 1.72. So I just don't like the way that those paths are crossing. PE's going up, the revenue's going down. Over the last 5 years, it's down 8.18%. Gross margin is not bad. It's at a 45.67. Return on equity is low at a 3.64. What I do really like about this company is it has a low debt profile. Debt to assets trailing 12 months is only 10.93%, and debt to equity is 18.82%. Now, when we look at the dividend yield, it's 1.12%, so pretty low. It has a dividend payout ratio, which is surprisingly high for a small dividend yield. It's at a 49.23%. So I don't expect this company to grow its dividend that fast, but over the past 1 year, it's at a 6.67% growth, which is good, but we'll just have to see what the future has for this company regarding its dividend. Now, with MOAT, it does charge a more hefty net expense ratio of 0.47%. Remember, SCHD 0.06. So that's a negative for me. I think that's way too high. Long term, these high expense ratios do eat at your gains. And if we look at the yield, it does pay a 1.28% yield, so that's pretty low. So for me, with this company, I'm gonna put it in 5th place. I just think it's a little pricey for the metrics it's giving us financially. I also am not big on the chemical, agricultural side of things. Yes, it's a necessity, but there's a lot of competition. And to me, I just don't see it as something that's going to generate dependable recurring revenue. It doesn't have that product that I think the customer, the consumer, whoever's utilizing this is going to buy over and over again, because easily someone can come in and say, hey, our product now is cheaper and better, and it's an easy switch, right? So I don't think it has that wide of a moat. I think, yes, it's in the agriculture business, which we all need to eat. We all need food. But overall, I'm just not convinced at this point, so it goes in 5th place and bumps SCHD up 1. Now we're going to talk about ARK. This one's probably one of the most talked about ETFs. It's the innovation ETF that Cathie Wood holds, and to my surprise, over the past year, it's up 24%. That is really good, but I will say, if you go search this right now and take it out 5 years, it's in the red. So if you invested 1 year ago, you're doing good, but before that, it's been a really rocky and a negative experience for investors. Now, ARK, with its top holding, you will see Coinbase, and it's at a very high weight of 9.86% of this portfolio. To me, that is risky, and I'll explain a little bit more why. So Coinbase over the last year, this blows me out of the water. It's up 296%. Is this sustainable? I don't know. A lot of this to me is just based on hype with the chance that this cryptocurrency will be the future, but that's a big if. Coinbase, keep in mind, just went public April 14th, 2021, so we won't have all the 5-year history data at this point, so a lot of those will be NAs. So this cryptocurrency exchange platform, if we look at its stock facts, we'll see its price per earnings are hefty, a 646%. Now again, it doesn't have that 5-year history because it only went public a few years ago. That price per operating cash flow, you're expecting a lot of growth in the future at 253.48%. That means this company better have explosive growth and just not stop for a long time with that explosive growth in order to justify the valuation that you're buying in at right now. Now the cash flow growth over the last 5 years is good. It's up 76.97%. But look at that revenue. Over the trailing 12 months, it's down 2.69%. The last 5 years, it's up 41.12%. So maybe there's some slowdown there, which I wouldn't like to see with paying for a stock that's got a PE of 646%, so not looking good in my eyes. Now, gross margin is very high at a 90.96%, but I think what offsets that is that very low return on equity at only a 1.61%. Now, it does have a low debt profile, which is good. Debt to assets is low at 2.1%. That's one of the lowest I've seen. Debt to equity is average at 54.43. Now, this does not pay a dividend. And if we look at the ARK ETF, it has the heftiest of expense ratios out of all of these on the list today at a 0.75%. Not only that, but I could not find recent dividend payments. The last one I found was in December of 2021, so as it stopped paying its dividends. I wonder if that's because the ETF has done very poorly and they decided not to make any distributions. So I do not like the fact that this Coinbase, which I am biased, I'm going to say that. I'm putting my own personal opinion on this, but I think it's okay to do that in this situation because cryptocurrency is something that is a bet that investors are willing to take that it will be the future. And I just don't believe that. I just don't think cryptocurrency is the future. I could be proven wrong, and I will take ownership of that if that is the case. But to pay this high of an expense ratio, that expensive of a company that makes up over 9% of your ETF, I just don't like this. I just see a recipe for disaster. So I'm putting this one in 5th place. So ARK, Coinbase in 5th place, which pushes up MOAT and SCHD. Now on to the last one, VWO. This is the Vanguard Emerging Markets Stock Index Fund ETF. Now this invests in stocks of companies located in emerging markets around the world such as China, Brazil, Taiwan, and South Africa. And over the past year, it hasn't done that great. It's only at 4.65%. And if we look at its top holdings, we'll see what makes up the top spot is Taiwan Semiconductor Manufacturing at a 6.31% of the fund. Now, TSM over the last year has done really well. It's up 56.73%. But a lot of these companies have done well. There's been a lot of demand. And if we look at its stock facts, I see a pretty decent company. Its price per earnings trailing 12 months is higher than the last 5 years at a 28.03 versus the 21.52. So yes, investors are expecting more from this company, and that's probably justified. I think this company has a bright future. Price per operating cash flow trailing 12 months is 16.19, with the last 5 years cash flow growth of 15.87. Not bad. Now, revenue over the trailing 12 months is negative 4.25, so there is some slowdown. We'll see what happens. This is something to keep your eye on if you like TSM. And the revenue growth over the last 5 years was up 21.61. Now, gross margins are really good at a 77.46, and return on equity is very healthy at a 26.06. That debt profile for this company is very healthy. It has a low debt to assets of 17.81 and a low debt to equity of 28.9. Now they do pay a dividend and their yield is 1.78, so pretty small, but that payout ratio, again, I don't know what, I just don't like when the payout ratios are this high for that small of a yield, but it's at 47.18 and they've been growing it pretty decent. The 1-year growth is 7.69 and the 5-year growth of this dividend is 8%. So with this ETF, VWO, it does have a very low expense ratio. Most Vanguard funds do. That's what they're known for. It's 0.08%. And it does pay a dividend of a yield of around 3.46%. So I'm going to put this VWO with the Taiwan Semiconductor of its top holding in 2nd place. So I think this industry has a bright future, at least in the short term. So I think it's deserving. And there you have it. Here's all 6 ETFs with their top holding and how I rank them. But there's more. We're going to look at my portfolio now. I'm in the green, 20.68%. But the stock that makes up the majority of my portfolio is Microsoft, and its allocation is a staggering 17.44%. But remember, I deem Microsoft almost as a ETF. It has a lot of different companies it owns, a lot of different products it puts out. I think this is one of the safest companies to invest in. Yes, it might be overvalued right now, but I do not think it's in a bubble, so I don't see a big risk. So for me, I am going to rank myself right up there with SPY, and my ETF, if I were to have one, would be called MARK. So there I am. And remember, this is only judging these funds based on their top holding. If it were a whole portfolio, these rankings would definitely be different. So let me know, how did I do with these rankings? Do you agree with my rankings? What would you change on this chart? I hope this was a fun exercise that gives you a different way to analyze a fund that you were thinking of investing in. Of course, these funds do rebalance their holdings, so it's best to look at the ETF's overall objective, expense ratio, dividend payouts, etc. That's all for today. Happy investing, and we'll see you soon on Mark Arnold's Finance.